welcome to today's show. Today, we'll be talking about how to minimize your taxes. That's what we all want to do, but why is it so important to worry about minimizing your taxes when you retire?
Yeah, that's a great question.
Yeah.
And really, if you think about it, it's not what you make, it's not what you have, but it's what you keep. And a lot of people don't realize that. They see, let's say, for example, they have a 401k or something. They have $1 million in that. Well, at today's tax rate, that $1 million may be worth $700. But 5 years from now, that same $1 million may only be worth $500. So you never know what's really in the account because it's always going to change depending on who's in office or what the tax laws are.
Yeah, and I think that this is probably one of the number one issues that are facing retirees and pre-retirees that just not enough people are really talking about. You know, everybody, when they look at their retirement plans, everybody wants to minimize their fees. They want to get the best rate of return that they can, and that's all very, very important, right? But if you don't have a way to handle taxes in the future, in particular if taxes were to go higher than what they are today, then that can really cause individuals to struggle. It doesn't matter how good your rate of return is or how low your fees are. If taxes go up significantly in the future and you don't have a good amount of money set aside in something that'll be tax-free, then you're going to really struggle to have a secure retirement.
So what are some of your tips on getting that tax rate down?
Well, try and transition as much money as you can right now over into tax-free options. So everybody should pretty much have available right now Roth IRAs, certain income limitations, so not everybody can use a Roth IRA, but pretty much everyone can use a municipal bond. There are certain insurance strategies. You know, Melissa, a lot of times we'll meet with individuals in the office and they'll be overfunding their 401k, meaning they're putting in money over and above the company match. And that's certainly better than spending the money, right? It's a good place to save it. But putting it inside of that 401k or 403b, depending on where you work, might not be the best place for it. You know, we'll sometimes recommend that individuals contribute to their employer plan up to the company match and then take anything over and above that. Go ahead and take it out of the 401k yourself and then put that money into a Roth IRA or some other tax-free strategy.
And how should you get started with something like
Well,
this? Say you're young and you don't have a lot of money. Should you start now?
Well, I mean, hopefully your advisors are talking to you about these types of things. And hopefully, you know, right now we're in one of the lowest tax rates that we're probably ever going to see in our lifetimes. So ideally, your advisor should be talking to you about these types of things. If they're not, you should bring it up and start asking.
One of the things that we do at our office, if this is a concern, which it really should be a concern for most, but if the issue comes up, we can run an actual tax analysis and we can show individuals what they're doing currently. If tax rates just remain exactly where they are today and they don't really get altered very much moving into the future, we can show those individuals or couples how long their money will last, and we actually run this projection out all the way up to age 100. And a lot of times, people are in pretty good shape or not as in good a shape as what they thought, but we can make some recommendations to fix that for them. The one thing that we'll typically struggle with is when we run a scenario where tax rates go a lot higher than what they are right now. Like Dustin was just saying, where we are right now, historically speaking, is one of the lowest income tax environments we've ever seen. Tax rates have been much higher than what we've have right now in the past, and I think you can make a pretty strong argument that that could happen again in the future. If you look at changing demographics within the country, individuals are living longer, you have unfunded liabilities with Social Security, Medicare, Medicaid, the debt keeps going up every single year. Eventually we're going to have to pay more interest on that debt or start trying to pay that debt down. And all of those things are going to require potentially higher income taxes. So when we run this retirement income analysis, when we throw in a tax rate instead of 15%, maybe it's 25%, or maybe the current 30% bracket goes to 40 or 50%. In a lot of cases, if those individuals don't have a good amount of money set aside somewhere tax-free, they really start to struggle. And if you wait until tax rates go a lot higher in the future to try and start fixing the problem, at that point it's really too late. What you really want to do is take advantage of the low income tax rates that we have currently and see if it makes sense to start shifting more of your contributions over to tax-free options, and even seeing if you should start shifting some of the money you have in traditional IRAs or 401ks and moving those over to something that would be tax-free as well.
So this year specifically, are people seeing a lot of changes because of the tax laws, the change in the tax laws?
Yeah, there's a ton of our clients have already been taking advantage of it. I mean, when the tax rates went down for 2018, this is the time that we want to start taking advantage of that and talking to clients about
Yeah,
it.
because of the increase in the standard deduction, even individuals that are retired could possibly now even be able to shift additional funds over to things like Roth IRAs or municipal bonds, or some of the insurance strategies like we talked about. It's going to be easier to make those types of conversions this year and hopefully moving forward than what it's been in the past. In the past, we were more restricted and more limited to what we have today. So like Dustin was saying, your current advisor really should be talking to you about this because everything has changed. If they're not, then that's where we've got a tax analysis that we can run for individuals in the office.
We've even seen some individuals where they can shift money into their Roth or into a tax-free strategy with that standard deduction and pay no taxes.
And pay no taxes on it.
Yeah.
Well, that's music to everybody's ears.
Yeah, absolutely, absolutely. So there's a lot that should be done, but I think it really starts with getting an analysis done on your specific situation.
If you would like more information on minimizing your taxes, you can visit swdgroup.com. And stay tuned for more Strategic Wealth with Matt Dicken right after the break.
Well, if we think about that, back in the year 2000, we had just made it through the 90s. And the 90s were, I know a lot of you are thinking, were probably some of the best years that the stock market has ever had. Well, if you're thinking that, you're right.
Look, nobody's born knowing how to plan for retirement. So why not start your retirement education the same way thousands of Kentuckiana couples have by attending one of our educational seminars created and hosted by the financial professionals at Strategic Wealth Designers. The retirement professionals at Strategic Wealth Designers will show you ways to make informed decisions. For many, this workshop was the first stop on the road to their successful retirement. Register for an event that works best for you at swdgroup.com/events.
Hi, welcome back. I want to spend some time talking about something called a safe withdrawal rate. And basically what the safe withdrawal rate is how much money that you're allowed to take out of your accounts hopefully without running out of money. There was a study done years ago, back in I believe around 2000 by AARP, that said that 4% was the amount of money that you could take out of your accounts, and statistically you shouldn't run out of money during your lifetime. Well, if we think about that, back in the year 2000, we had just made it through the 90s. And the 90s were, I know a lot of you are thinking, were probably some of the best years that the stock market has ever had. Well, if you're thinking that, you're right. The stock market in those years was averaging around 14% per year. As a matter of fact, even bonds back then were averaging around 6% per year. Well, back in 2000, that study was put out, I believe it was, that said 4% is how much you could take out of your accounts. So if you have $1 million portfolio, that would mean that you could pull out about $40,000 per year out of that account. And statistically speaking, you have about a 90% success rate. So you shouldn't run out of money if you're doing that. Now, this study was done on a 60-40 split, which means you're using 60% stocks, maybe 40% bonds. Well, let's fast forward to today. Is the stock market still averaging 14%? I wish it was. The stock market now is averaging right around 8%. So pretty different than a 14% per year average. And bonds today are averaging around 3%. So about half of what they were back in 2000. Well, would you think that we could still take 4% out of that account per year? Probably not. As a matter of fact, Wall Street Journal put out a study, it's been a few months back, maybe a year ago now, that said that a safe withdrawal rate at this point is around 2 to 3%. So think about that. If you have $1 million portfolio, let's say you've worked your entire year, you've put money away every single month from your paycheck, and now you've accumulated this nice nest egg. You've got maybe $1 million saved up. Well, you're going to move into retirement, and what that study tells us is we could take somewhere between $20,000 and $30,000 a year out of that account. That's probably not going to excite a whole lot of you, and it shouldn't. It wouldn't really excite me either. There's still ways that you can achieve a 4 to 5, maybe even 6% withdrawal rate, but it's not using that old 60-40 split that maybe your mom and dad used to, or maybe when I'm speaking, it was my grandparents that used that. Today, investment strategies, tools, objectives are very, very different than they were back in 2000. So your investments must evolve with the times. You could still try that stock and bond strategy, and it may work. But statistically speaking, 2 to 3% is all you could really take out of that account and not run yourself out of money. So we talk a lot at our firm about something called the Rule of 100. Now, we work primarily with those that are retired or within about 10 years of retirement. So really, this is what our firm is based around, is generating income plans that our clients can pretty much bank on. They know what it's going to be for their lifetime. There's a little bit of fluctuation, but it's not going to be nearly what the stock market would be. So what that means is, what the Rule of 100 is whatever your age is, you take that from the number 100, and that would be the percentage of your assets that you want to be in a very safe and protected environment, getting guaranteed results year after year after year. Then, if you're comfortable with risk, then with the balance of that portfolio, that's where you can go out and take a little bit of risk. So let's think about that. Let's say that we have that same couple, and they've saved $1 million in their portfolio, and now they're, let's say, 65 years old. Well, that would mean 65% or $650,000 of their portfolio they would want to have in something that's safe and protected and guaranteed, getting income that's going to last as long as they need it to. Now, there's some companies out there that will even offer up to a 6% guarantee. So 6%, I mean, if you think about that on a $650,000 portfolio, that's over the 2 to 3% withdrawal on the $1 million, and you've still got $350 left. So 6% on $650,000 is $39,000 per year. Then with the balance, that other $350,000, now you can go out and play with a little bit of stock market risk and maybe use some of those 3% bonds that we were talking about a while ago, or maybe try to go after those 8% returns that the stock market is averaging. So if you're nearing retirement, if you're within 10 years or so of your retirement, and you're thinking, well, I'll just use that 60-40 rule that Mom and Dad talked about, things have changed today. It's time to reach out and talk to someone that specializes in retirement planning. Give us a call at our office, and we'd be happy to talk with you about how to structure your portfolio to transition over into your retirement years. We look forward to hearing from you. Well, first of all, you have to start with the end in mind. What are we trying to do? We're trying to accomplish a retirement where you don't have to be worried about what's happening in the market every day and watching the stock market. You don't want to be paying any fees that are unnecessary.
WHAS 11 salutes Strategic Wealth Designers as a leading retirement and wealth management firm in Kentuckiana. The advisors at Strategic Wealth Designers have been helping retirees and pre-retirees live a safe and stress-free retirement since 2002.
So Dustin, let's spend some time talking about why it is so important to work with a fiduciary. I know that we've discussed it here on the show, that the title or the word fiduciary has been in the news quite a bit. I don't know that that's a title or term that everybody understands, but what is a fiduciary and why is it so important?
Yeah, most people, I mean, I find it funny now that it is a buzzword, and really nobody knows what it means, and why would they? It's not a word that we use every day. Really, the difference is, and I always equate it to, the fiduciary is kind of like someone sitting on your side of the table, negotiating on your behalf with the companies, where a salesperson or a representative is the other standard that they follow, would actually represent the companies negotiating against you. So I always think it's important to work with a fiduciary, just because you know that they're going to have your best interest in mind.
Okay, well, let's talk a little bit about the process that you would go through with a fiduciary. I mean, I know at our firm, Strategic Wealth Designers, we really talk that there's a big difference between advisors that are out there that you can work with. We really tend to specialize in those that are closer into retirement, meaning you plan on retiring within about the next 10 years. And at that stage, you really start to move from what we refer to as the accumulation phase of your retirement planning, where you're trying to accumulate your assets, putting money into a 401k or 403b, things like that. And you start to get into the second phase of your retirement planning, which is the distribution phase, where now you've achieved this certain level of liquid net worth, and you're trying to figure out, how do I take this nest egg and turn it into income that's going to last me the rest of my life? So what would a fiduciary go through in order to try and help somebody through that process?
Well, first of all, you have to start with the end in mind. What are we trying to do? We're trying to accomplish a retirement where you don't have to be worried about what's happening in the market every day and watching the stock market. You don't want to be paying any fees that are unnecessary.
Right.
And really, you need to understand how much risk not only are you comfortable with, but how much do you really need? You know, a lot of times people are comfortable with a certain level of risk, but they don't really need to have that much. So a fiduciary is really going to help you to find out what is it going to take to accomplish your goals.
Yeah. Now, we have a few tools in the office to help individuals through that type of process. I think it first and foremost starts with our retirement income analysis, where, like Dustin was talking about, we can get together and look at all of your goals, your objectives. You know, what is it that you're trying to accomplish? What type of income do you need? For how long do you think you're going to need it to last? And then take a look at what your current situation looks like as far as income. You know, how much you're going to get from Social Security? Are you going to have a pension plan or not? You have so much money in your 401k plan or IRAs. How much income will you be able to draw from those? And then we really map that out all the way to age 100.
Yeah.
Right?
Yeah.
Now, part of that process, you said that we take a look at the fees
Take a look
and
at
the risk as well. Can you talk
That's
about
right.
that a little bit?
Yeah, so I find it, most everyone you talk to thinks they're paying 1% a year. I mean, that's the most common answer. I get it. I get it almost daily. But when we really dig in and we look at not only the fee that you're paying your advisor, which that's what everyone's familiar with. They know they're paying their advisor something. Most of the time it's 1%, 1.5%, something like that. But if they have mutual funds in their portfolio, that's only one of the fees.
Yeah.
So you have to look at each individual mutual fund to find out what's really going on under the hood.
So sometimes there could be 2 or 3 or 4 or 5 different fees that we have to add up in total.
That's right. That's right. And you know, they could find out what their fees are, but the way they do it, you know, to disclose those fees to the client, it's not real easy to find.
Right, and that's why we have what we refer to as a strategic wealth report, where all these different numbers that Dustin and myself are really discussing, we put it on a simple, easy to read, just one-page report. We can take a look at all the different accounts that you have and show you exactly what the fee is that you're paying. We put in a percentage amount, we put in a dollar amount, total it up, and obviously that's something for you to keep. Now, what about risk? How do we determine how much risk?
Yeah, that's an interesting one as well. I know that when you go into a brokerage house and they assign you a number, they ask you what's your comfort level. You go through and you take all the tests, the 20 questions or whatever, and then they give you the beautiful printout that says you're a moderate investor. But moderate actually means you're comfortable with a 30% potential drop or 30% risk in your portfolio. And we find that when our clients say moderate, they mean they're only comfortable with maybe 8% or something
they
like
really
that.
weren't thinking 30%.
Right,
Yeah.
right. So there's a massive disconnect in what's really going on versus what the client is not only comfortable with, but what do they really need. So we can use a software, the stress test, where we actually plug in the client's stocks, bonds, mutual funds, ETFs, whatever they currently have, and then we can run it against just about any scenario that you could think of.
Yeah, that's something that I really like about the program, because you have all these things that can happen to you during your retirement or leading up to retirement, whether it be another market correction or some sort of military exercise that happens overseas, or maybe the economy improves or it doesn't improve.
What if interest rates go up or don't?
Right, so we basically can stress test the portfolio against each of those different scenarios and see what the projected impact would be. Now, when we do that, really kind of what we're looking for are any common denominators. Are we seeing a problem, across multiple situations that obviously we might want to address and might want to try and find some ways to reduce the level of risk. So, I know that we tie this all up in kind of a package that we provide to those that are closer into retirement. So why don't you talk a little bit about that?
Yeah, it's called the Blueprint. It's a great tool that I know if clients are retired already, or especially if they're within 10 years of retirement, the Blueprint includes all of that. So you get to look at what are your fees, are there anywhere you can reduce those? You can look at how much risk is currently there, do you really need that much? And then really the retirement income analysis is where it ties everything together. That's where you can see how much your Social Security is going to be, how much to maximize your pension, or how do you leverage these assets now that you know what they are? How do you leverage those for income? And then how long is that money going to last you?
And that's really what we're discussing here, and that's why it's so important that you work with a fiduciary, because that's kind of what our fiduciary process is. Again, we've called that the blueprint that we provide for those that are close or into retirement. And it's really important as you're closer into retirement, again, meaning within about 10 years of possibly needing to use your retirement assets. Why don't you wrap us up here by talking about how important it is to make sure that you're not just working with a salesperson or someone that's just kind of trying to push product, but really working with a true fiduciary.
Yeah, I know because it's become such a hot topic, a lot of times people think that everyone has to be a fiduciary now, and that's just not the case. There are some rules now that people have to follow, but that's not for all of the client's dollars. So they may be tied to these rules in one portion, but not necessarily the other. So you always want to make sure that whenever you're working with someone, they are a true fiduciary. They're a registered investment advisor or maybe a certified financial planner. But you want to make sure that they're a fiduciary and that they have your goals and objectives in the front of their mind.
Okay, well, great. Well, anybody that would like more information about our fiduciary process, again called the Blueprint, please feel free to give us a call at the office and/or visit our website. When you talk with someone like ourselves, who's kind of focused on your retirement planning, we're trying to minimize the impact of taxes, not just this year or this past year, but really over the course of your lifetime.
Look, nobody's born knowing how to plan for retirement. So why not start your retirement education the same way thousands of Kentuckiana couples have? By attending one of our educational seminars created and hosted by financial professionals at Strategic Wealth Designers. The retirement professionals at SWD will show you ways to make informed decisions. For many, this workshop was the first stop on the road to their successful retirement. Register for an event that works best for you at swdgroup.com/events.
One question a lot of individuals have for us when they come to the office is if they should use a traditional IRA or a Roth IRA. Now, I think a lot of CPAs and accountants that are out there a lot of times will recommend just using the traditional IRA. And you have to kind of keep in mind the reason why they might recommend that. Their job really is to try and minimize how much you're having to pay in taxes this year, or you're doing this decision during tax time, kind of how much you're going to owe in taxes for last year. When you talk with someone like ourselves, who's kind of focused on your retirement planning, we're trying to minimize the impact of taxes, not just this year or this past year, but really over the course of your lifetime. So either option could be a good place to save money. More often than not, we really prefer the Roth IRA versus the traditional IRA, and we'll talk about a few of those reasons here in a moment. But first, with either option, you can put up to $5,500 per year into either one of these plans. Per person. If you're over age 50, you can put up to $6,500 into the plan per person. So a married couple could save as much as $13,000 per year in either a traditional or a Roth IRA. Again, if you're over the age of 50. That money is either going to grow tax deferred moving forward in the traditional IRA or tax free in the Roth IRA. Now, one advantage that the Roth IRA has over the traditional IRA is that there are no required distributions in the future. So with 401ks and traditional IRAs, once you turn age 70 and a half, whether you want to or not, the government starts making you take a percentage out of the account each and every year. The Roth IRA eliminates that. You do not have to take any money out of the plan unless you want to. And of course, in the future, when you do take money out of the Roth IRA, it's going to be completely tax-free, both what you put in originally and any of the growth. You won't have to pay any taxes on those earnings. So which is better really depends, in my opinion, on what future tax rates will be. You can make probably a pretty strong argument that taxes will probably have to go higher in the future than what they are right now. If you take a look at some of the changing demographics we have as a country, we have unfunded liabilities with Social Security, Medicare, Medicaid. Obviously, we have an ever-growing debt that we're going to have to start to pay back at some point. So I think if you take a look at it, you can make a pretty strong argument that taxes will probably be higher in the future than where they are currently. So whether you should do a traditional IRA or a Roth IRA basically comes down to this. If you think that for some reason taxes will be lower in the future, then a traditional IRA will work out better for you. If you think that tax rates could possibly be higher in the future, or at least be higher when you start taking money out of the plan, then the Roth and the fact that it's growing tax-free is going to be the better way to go. Now, if you think tax rates will be about the same as far as where they are right now, then I would really suggest go ahead and use the Roth IRA. The reason for that is when we meet with individuals, usually most of their money is in this tax-deferred bucket, which again is where the traditional IRA will fit, and they'll have little to nothing saved in their tax-free bucket. So even if you think tax rates will be about the same, go ahead and use the Roth, so then when you do start taking some money out for retirement or needs in the future, we'll have that as an option. Now, the reason why we really like the Roth IRA versus traditional IRAs is because we want to minimize taxes in the future, like we talked about. there's a myth out there that I think a lot of people buy into, and it's this. I think a lot of accountants or other individuals have been out there telling people that they're helping and working with is that when you go into retirement, you're going to be in a lower tax bracket than when you're working. And I referred to that as a myth, and the reason why I'm saying that is we've helped literally thousands of clients over the years go into retirement, and I can probably count on one hand how many times their tax rates went down in retirement. And a lot of times their tax bracket or their tax rate stays exactly the same, and in some cases it'll actually go higher. And one of the big reasons for this is the fact that when you go into retirement, you've lost all of your deductions that you were used to enjoying while you were working. Meaning usually the house is paid for, or even if the mortgage deduction hasn't been eliminated, you've probably been in the home that you're in currently for a very long time. So whatever you're paying each month, most of it's just going to principal, very little is going to interest, which is good, not to pay unnecessary interest, but it doesn't help you when you file your taxes. Another large deduction that is gone is your children's deduction. So usually you go into retirement, the kids are grown and gone, or at least you hope that they're grown and gone out of the house. Sometimes they'll come back, but if that happens, then you can't deduct them. So usually the deduction for children is gone. You're no longer contributing to a 401k plan or 403b plan, so you don't have that deduction. And then also in a lot of cases, your charitable deduction will change, meaning we have a lot of clients that while they're working, they'll give money to their church or charity of choice, but when they go into retirement, it's not really that they stop being charitable, but maybe instead of just writing a check and have others do the work, they'll actually go and volunteer their time themselves, which is really admirable, but the IRS unfortunately will not allow you to deduct your time. So usually what's happened is all of these deductions that we used and enjoyed while we were working, once we go into retirement, they're kind of eliminated. If all of our money is in a traditional IRA or 401ks, things of that nature, then everything that we withdraw out of those plans each year, we're going to have to pay ordinary income taxes on, and we have little to no deductions to try and reduce the overall tax rate. So a lot of times individuals go into retirement and they're in the same bracket, if not higher. So that's, again, another reason why you want to consider using the Roth IRA. And then last, you can invest whatever you want to within that Roth IRA. So you're not limited to just stocks or bonds or CDs or annuities. You literally can invest in anything that you would like. And if you have questions on that, feel free to give us a call in the office. And again, we can kind of do an analysis for you to show the impact of either growing your money in a traditional IRA or a Roth IRA.
Look, nobody's born knowing how to plan for retirement. So why not start your retirement education the same way thousands of Kentuckiana couples have? By attending one of our educational seminars created and hosted by financial professionals at Strategic Wealth Designers. The retirement professionals at SWD will show you ways to make informed decisions. For many, this workshop was the first stop on the road to their successful retirement. Register for an event that works best for you at swdgroup.com/events.
WHAS 11 salutes Strategic Wealth Designers as a leading retirement and wealth management firm in Kentuckiana. The advisors at Strategic Wealth Designers have been helping retirees and pre-retirees live a safe and stress-free retirement since 2002.